Singapore, a city-state known for its economic precision, global dominance, has issues a chilling warning. A technical recession may be around the corner, and the trigger rising global tariffs, especially between United States and China. On the surface, things look promising. In the first quarter of 2025, Singapore's GDP grew by 3.9% compared to the same period last year. That's better than the 3.6 economists expected, and it even beat the government's own estimate of 3.8%. But here's the catch. When we zoom in and look at the quarterly performance, Singapore's economy shrank by 0.6%. That marks the first signs of contraction, and it's raising serious alarm bells. A technical recession occurs when an economy contracts for 2 quarters in a row, quarter on quarter. According to Bae Swain-jin, Permanent Secretary at the Ministry of Trade and Industry, this is a possibility, but not yet a full-blown recession. A government is being cautious. The 2025 full-year growth forecast remained at just 0 to 2%. That's a wide and low range, reflecting the uncertainty ahead. So, why the worry? It all goes back to trade tensions, especially the tariff war between the United States and China. Even though both countries recently agreed to a 90-day truce, Singapore remains extremely exposed. Why, you may ask? Because trade equals 3 times Singapore's GDP. It is one of the world's most important trade-dependent nations. A single ripple in the global commerce can feel like a tidal wave in Singapore. The impact isn't limited to one area. A broad sector-wide slowdown is expected. The outward-oriented sectors like manufacturing, wholesale trade, transports, and storage are all projected to weaken. Even the finance and insurance sectors are at risk due to falling trading activity, and for consumer-facing sectors, this outlook is, in one word, lackluster. Interestingly, part of the growth in the first quarter came from businesses rushing to beat the tariffs. Exports surged as companies tried to ship goods from higher US tariff kicked in. That temporary boost may not last. And with the temporary US-China truce hanging by a thread, any re-escalation of tariffs could reignite a global trade war. Singapore's policymakers are watching this closely. The Monetary Authority of Singapore, or MAS, has already eased its policy stance twice this year. They are preparing for a comprehensive reassessment during their July meeting. Edward Robinson, Deputy Managing Director at MAS, emphasized the policy stance remains appropriate as of now, but they are leaving the door open for change. Bae Swan-jin summed up the situation best. The global economic outlook remains clouded by significant uncertainty. The risks are tilted to the downside. Whether it's tariff escalation, global inflation instability, or recession in major economies, Singapore is preparing for the worst while hoping for the best. Singapore may have weathered many storms in the past, but in 2025 the cloud of global economic conflict are gathering again. Will the island nation navigate through or fall in technical recession? Stay tuned as we continue to track the global economic pulse of Asia's financial heart. Don't forget to like, share, and subscribe for more such updates.